My name is Jake, welcome to the channel. In today's video, we're going to talk about a dividend growth ETF that is very unique, that not a lot of people talk about, but it has a 12% dividend CAGR, and spoiler, it's actually tracked and outperformed the S&P 500 since its inception. It's a kind of, I think, misunderstood ETF. Not a lot of people talk about it, but it's an ETF that I want to do a deep dive in this video, and I think a lot of you with a long-term time horizon, I'm speaking to you 20-year-olds, 30-year-olds, those that have a 15, 20, 30-year time horizon, this is an ETF that you probably want to have on your radar. Or if you're an old timer, or if you have kids, this is maybe an ETF to add to your kids' portfolio. And the ETF that we're going to talk about in today's video is DGRW from WisdomTree. So in today's video, we're going to cover a couple of topics. First, we're going to do an overview or a deep dive into DGRW. Second, we're going to do a deep dive into the methodology behind the index, which is the WisdomTree US Quality Dividend Growth Index. Then we're going to compare DGRW versus SCHD. We're going to look at the price action. We're going to look at the total returns. Going to talk a little bit about the comparisons there. We're also going to compare DGRW versus the returns of the S&P 500, as well as the total returns. And then we're going to review DGRW with a dividend compound investment calculator. And we're going to forecast and see what would your potential returns look like over a 10, 20, 30-year time horizon and all of that stuff. And then finally, to end the video, I'm going to share my thoughts on what I plan to do with this ETF. In terms of full disclosure, I don't own this ETF today. I don't own it in our little baby boy's portfolio. My wife doesn't own it yet. And so this is an ETF that I don't own today, so I'm trying to be objective. I don't have any motive behind making this video other than I think it's a really interesting, unique ETF that I think could be, there's absolutely potential here. And you'll see, if you watch the whole video, you'll see what I mean by that. But I'll share towards the end of the video what I plan on doing with this ETF. So those are the main points that we're going to touch on in this video, and I would encourage you to watch the whole video. There's a lot of things in here that I think is going to really open your mind to what this ETF is and the potential of it. And I think a lot of people don't look at this ETF because it has a higher expense ratio. Okay, so I'm going to touch on that. It is very, very important, but I want to look at every aspect of this ETF and see if it makes sense, if it warrants investing into it despite the high expense ratio. But I'm sure that there's going to be some noob in the comments who's going to type something like, Jake, why are you recommending, or why are you talking about an ETF that has a high expense ratio? What's wrong with you? I'm just like, calm down, dude. Like, that's what I have to tell my wife all the time. Calm down, dial it down, calm down. But even then, I'm sure that there's going to be some troll noob in the comments section that doesn't watch the video, looks at the expense ratio, decides to write a comment, and then turns off the video. And it's probably going to look a little like this.
Hey, Pop. Hey, Scotty. How you been, sport? Whoa! I hate you. I hate you. I hate you. I don't even know you, but I hate you too. And I especially hate you. You'll pay. You'll all pay.
Oh my gosh. I read every single comment and I can't tell you how true that is. All right. So anyways, we're going to primarily be in Seeking Alpha. I'm going to walk through all the dividend metrics, the holdings, everything here. For those of you that have been following the channel, you know that I love Seeking Alpha. I use it every single day. I would never recommend something that I don't personally use. I've been using this site for years. If you do want to use or sign up to their premium, I will leave a link in the description below. It will look a little like this. So with my link, you will actually get the very best pricing possible. Instead of $239 a year, the first year here, you'll pay $99. I want to be very transparent. I do benefit from it. It is an affiliate link. But yeah, no pressure if you want to use it. So anyways, so what we're going to look at, I want to look at some of the dividend metrics. I want to look at the holdings, all of that good stuff. And then we're going to talk about the fund methodology. First off, let's take a look and let's look at the fund profile here. So this is a US-based equity ETF, and it's primarily focused on large cap. So large cap companies like Coca-Cola, Pepsi. You're not going to get any small cap or unprofitable growth stocks in this ETF. This is skewed heavier towards a higher growth value like companies like Apple, Microsoft. And once again, it's just focused on the US. There's no international. It's been around since 2013. It does have a high expense ratio. Okay, so the expense ratio is higher, much higher than the S&P 500. If you look at other traditional dividend growth ETFs like VIG, DGRW, SCHD, they range anywhere from 0.06% to 0.212%. So this is anywhere from 2 to 3 to 4 times more expensive than an ETF like SCHD or VYM. Okay, so I want to preface that if there was anything, stopping you from investing in this ETF, the expense ratio is front and center. Okay, so I want to make sure that I highlight that. The assets under management, this is actually pretty good. It's not a small fund. Like, this is actually pretty dang good. Okay, and we'll look at the total returns here in a second, and we'll go in the charts and I'll walk you through all that. The holding breakdown here in Seeking Alpha, this is fairly accurate. If you go on their website and you update it as of the end of August, it will look a little bit different, but their largest sectors are technology and defensive. And obviously it changes here as the market changes because it's market cap weighted. The largest holdings in here, you got your Apple, Microsoft, Johnson & Johnson, Coca-Cola, Philip Morris, Merck, Procter & Gamble, Altria Group. So you got 2 tobacco companies in here. Interesting. United Healthcare and Pepsi. So there's one thing I like, there's one thing I don't like or not like as much. The total weighting of 37% is pretty high. I'm not the biggest fan of that, but look at the type of companies that we're talking about. We're talking about Apple and Johnson & Johnson and Microsoft. I'm okay with them being so high. It's similar to the S&P 500. The one thing that I do like is I like that there's just about 300 holdings. I really like that. Okay, more holdings, more diversification. I personally really like that. Now, when we look at the dividends here, the dividend yield is right around 2%. It's not the highest. The dividend growth rate, this is what's really exciting. It has, over the last 5 years, over a 12% dividend CAGR. This is massive. Now, this is something that is unique about DGRW than DGRO, SCHD, VYM, most other traditional ETFs, is it pays a dividend monthly. Okay, so you see this expense ratio up here, this higher expense ratio. You have to look at that and you have to kind of peel it back and see, okay, well, why is it so high? Now, if this was paid quarterly, I think it would be very difficult for them to justify this high expense ratio. But the fact that it pays monthly, this is really interesting. Now, what this reminds me of, it reminds me of the Invesco High Dividend ETF, SPHD. SPHD. Let me type this in here. SPHD. It's very similar to this ETF. SPHD has a little bit of a higher expense ratio. It also pays monthly. But if you compare the two, DGRW is actually just destroying SPHD in terms of the total return. But I think when it comes to the expense ratio, this is where I'm like, okay, guys, all right, you got my attention, because there has to be a fee for it, because not a lot of these ETFs, these funds, they don't pay monthly. So that is something that is very unique about this ETF. But one thing that I do want to make sure I mention is this, though it pays monthly, you're not getting the exact same amount of dividends each month. And we'll touch on that in a second. So this is not like a QYLD or a JEPI, like it's a little bit different. The dividend growth has been pretty solid over these last couple of years, right? Since its inception. And now let's go down here. The last thing that I want to show you here, a couple of things, is the turnover. So whenever I look at ETFs, I always look at the turnover of how frequent companies or individual companies are getting replaced, coming in and out of the index here. And I will say that 30% here, this is actually pretty high. A 30% turnover is high. When you compare it to like VYM, it's higher, though SCHD actually has a higher turnover rate. Okay, so it's something to take kind of with a grain of salt. It's important to be aware of. You look at the S&P 500. The S&P 500 has a near zero turnover rate. It's like 2% or something. So it's something to be aware of. It's not. I wish this was a little bit lower, But if I were to summarize the cons, if we were to, look at the cons and get them right out there, con is it has a high turnover rate comparatively to like VYM, for example, though it's lower than SCHD, and the expense ratio. Now, those are the cons. Everything else, in my opinion, from here on out for the rest of the video is all going to be positive. Okay, so if these two cons, the high expense ratio and the high turnover rate, did not scare you away, I think you're only going to be pleasantly surprised throughout the remaining part of the video here. Okay, next what I want to do is I want to scroll up here and I want to look at the flows, the inflows. So now the flows are how popular this ETF is. Are people, are institutions and individual retail investors, are they purchasing? Are they buying this ETF? Or is this an ETF that is just kind of fallen off a cliff and nobody's purchasing? This ETF has great inflows. When you look at it from month over month, the last year, the last 3 years, this is a very popular ETF. And I wanted to go a step further and I wanted to compare it to a few other popular ETFs, dividend ETFs. Comparing it to QYLD, JEPI, DEVO, DGRO, SCHD, and VYM. Of the bunch here, SCHD has been the most popular. I don't know if it's because of YouTubers pumping it on YouTube or what. I'm sure that that's part of it, but it is an incredible ETF, plain and simple. But when you look at the others here, JEPI, very popular, VYM, very popular, DGRO, very popular. DGRW is a little bit, it's not quite as popular as others. And I think, it's because, in my opinion, I see it kind of as a hidden gem. Now, if I were to kind of theorize why that is, I think part of it has to do with the expense ratio. The other part, I think, has to do with WisdomTree, right? The issuer of the fund is not as well known as JP Morgan or Schwab or Vanguard or BlackRock, for example. So take that with a grain of salt, but I thought that was interesting comparing the flows. All right, now let's go back and let's take a look at some of the dividend metrics here. So I guess the thing that I want to highlight the most here is the dividend yield. This dividend yield is higher than the S&P 500, okay, very important, but it's lower than other dividend ETFs like SCHD or VYM, okay? Now, if you look at the dividend yield over the last 5 years, it's hovered right around this range, right? So right around the 2% range. And if you go down here and you look at the average yield since its inception, it's averaged right around 2%. Okay, so if you're dollar cost averaging into DGRW, you could reasonably expect right around just over a 2% forward dividend yield. Okay, the yield on cost is very interesting. If you look at since its inception, you're getting about a 5% dividend yield, which is not bad, right? So you're getting, I believe this is beating the S&P 500 if I'm not mistaken. The dividend yield, so this is my opinion. Whenever you see DGRW at that 2.5% yield, that's where I'm thinking to myself, okay, this is very, very interesting. If you ever see this ETF at 2.5% starting dividend yield, the market, because this is heavier focused on technology, the overall market's probably correcting. And I think it creates an opportunity to start a position into an ETF like this. Now, I'm only saying that as an example of how I would view this. If you wanted to put this in an M1 account and dollar cost average, I don't think you could go wrong with that. But you have to understand that you're going to average right around a 2%. If you did wait and pick when you entered a position into this and you want to be more strategic and maybe time the market, which I'm not really advocating for, but there may be a better opportunity to get more value by picking and choosing when you invest in this ETF. So just food for thought there. Looking at the dividend history, this is what I was talking about with the dividend yield being a little bit different than maybe a QYLD or a JEPI. The dividend yield, it gets paid monthly, but you're going to get a higher dividend yield on the traditional cycle in March, in June, in September, and December. So you'll notice here, if we look at September, it's higher than the previous months. If we look at June, it's higher than the other months. If we look at September, it's higher here. And if we look at December, it's higher here. So yes, you're getting paid monthly, but you're getting paid more on the traditional cycle, right? So that's where the expense ratio, in my opinion, comes in, is really when it comes to offering that additional dividend every single month. Okay, so you're going to have to make your own opinion if that's the right choice for you. Do you want to pay the extra expense ratio? It really comes down to you. I mean, people pay almost 3/4 of an expense ratio for QILD, and it's vastly underperforming the S&P 500, myself included. I invest in it. So I guess, it depends on what your priorities are. In terms of the quant rating and the ratings here on Seeking Alpha, the quant rating is proprietary to Seeking Alpha. So this you're only going to see with Seeking Alpha Premium. This is objective. This is not anybody's opinion. This is based off of a proprietary model that they use when it comes to evaluating whether or not an index or a stock, individual stock or ETF, will under or outperform. And this is showing that it has actually a buy rating. So it does have a very good positive quant rating here in Seeking Alpha, which is positive. Once again, take that with a grain of salt, how you want to view it. But that's, for me, it's just kind of reassuring, and it's nice to see. All right, now let's take a look at the fund methodology, because if you follow the channel, you hear me say this all the time. The performance of this ETF will be based off of the index, okay? So what I want to do is I want to read this here really quick, because this is probably the most important thing. My opinion only can mean so much, because the index really dictates how this ETF is going to perform. So the WisdomTree US Quality Dividend Growth Index is a fundamentally weighted index that consists of dividend-paying stocks with growth characteristics. The primary starting screening universe for this index is the constituent of the WisdomTree US Dividend Index with market capitalization of at least $2 billion. So it's market cap weighted with a $2 million minimum. The index is comprised of 300 companies in the WisdomTree US Dividend Index with the best combined rank of growth and quality factors. The growth factor ranking is based on long-term earnings growth expectations, while the quality factor ranking is based on a 3-year historical average for return of equity and return of assets. The index is dividend weighted annually to reflect the proportionate share of the aggregate cash dividends each component company is projected to pay in the coming year based on the most recently declared dividend per share. The index was created here in 2013. Okay, so the main thing that you have to understand with this index, how it compares to SCHD and every other dividend growth index out there, is it's future looking. All other index are screening based off of historical dividend growth. Okay, let me say that one more time. This is really important. This index is forward looking. It's looking at the potential of future growth based off of predetermined rule-based screening and not based off of what a company has done historically. Let me give you an example. AT&T. AT&T is on every, dividend growth, index out there. But if you look at charts, you can see that it's continually underperformed, right? Though it was on every, dividend growth index out there. The difference here is this index, once again, it's forward looking, it's not backwards looking. Now, if we were to actually go and we look at if we look at the rule-based methodology, let me look at this here. Let me scroll into this. Maybe you can look at it a little bit better. So in the case of WisdomTree US Quality Dividend Growth Index, the following capping rules are applied. So this is a rule-based index. The maximum weight of any individual security is capped at 5% on the annual rebalance, so it's rebalanced annually, prior to the introduction of sector caps and the weights of all their components within adjusted proportionally. Should the technology sector achieve a weight equal to or greater than 25% of indexes, weight of companies will be proportionally reduced to 25% of the annual screening date, okay? Last thing here, another thing here, real estate sector will be capped at 10%. I really like that. It means it's tax efficient. All other sectors will be capped at 20%. Okay, so this is the rule-based methodology that this index uses. Now, I want to go in and I want to take a look at how this index compares to the S&P 500. Let me scroll in here. Let's see if you can see this a little bit better. All right, now you can see it a little bit better. Okay, so over here on the left, this is the DGRW. This is this index versus the S&P 500 based off of the sector weighting. Okay, so you can see here that it's actually fairly similar. You really have to kind of squint your eyes and see, okay, well, what are the differences here? If you really want to see the differences between DGRW, the weighting in DGRW versus the S&P 500, look over here to the right and you can see it a little bit different, a little bit better. So you can see that industrials are weighted significantly higher in DGRW and in consumer staples. Okay, so as well as materials, consumer discretionary, information technology, and healthcare. Okay, so what that tells me is if you look at this historically, industrials, healthcare, information technology, not staples, materials not so much, and discretionary. All of these others except for staples and maybe materials are more growth centric, right? Real estate, energy, utilities, financials, communication services are not generally growth indexes, okay? So just right off the bat, the way that it's structured more for growth, right? It's skewed more towards growth. But I thought that this was really interesting to see how the breakup, how different these indexes are set up, though they are fairly similar. And this will make more sense once we look at the total return here in a second. And it is worth saying as well, when you look here at consumer staples, how there's a higher allocation to staples, you would then expect a lower beta in DGRW versus the S&P 500. In fact, that is actually the case. Your beta here is the volatility. You're actually going to have lower volatility in DGRW than in the S&P 500. All right, now let's compare SCHD with DGRW, and I want to compare first with the fund overlap. I want to see how similar these indexes are. And so to do that, what we're going to do is we're going to look at the percentage overlap in the two here. So what I want you to focus on is right here, the overlap by weight. 28% is the fund overlap. So if you were to combine SCHD and DGRW, 28% of the total holdings are going to be overlapped or similar. Okay, that's actually not that bad. It's more different than it is similar. So in my opinion, if you were to ask me, well, Jake, does it make sense owning both? Well, the fund overlap is not high at all. In my opinion, I could see a case where you could have both separate. So you could have SCHD and DGRW. Now, when you compare SCHD versus DGRW, what you have to first understand is these are different indexes, right? So we're not going to look at the dividend growth. We're not going to look at all those other metrics. If you're interested in how SCHD is set up, I will leave a link in the top right here to a deep dive into SCHD. But what I want to look at here is just the performance, how they have performed in terms of the price as well as the total return. And as we know, DGRW was, the inception date was here, the end of 2013. So we're going to look from the beginning of 2014, if you just compare the price return, DGRW has outperformed SCHD. Now, when we compare the total return, which is with the dividend reinvested, you can see that SCHD has actually slightly outperformed DGRW. But you look at this, like up until the pandemic, like you can't even see the two lines in some cases, right? So very, very similar performance, very growth oriented. And, I think, 3% is so marginal, is so small, so minimal. I absolutely love seeing that DGRW is holding its weight against the famous SCHD. Everyone on YouTube talks about SCHD. They don't talk about DGRW. All right, now let's do the exact same thing and let's compare the S&P 500 with DGRW. Looking at the exact same thing here, looking at the fund overlap, 40% overlap with the S&P 500. So a little bit more than with SCHD. Still, in my opinion, not high enough where I would say, okay, you would want one or the other. I could definitely see a case where you could hold both VOO, the S&P 500, and DGRW in the same portfolio. Now, when you compare the returns of DGRW versus the S&P 500, once again, looking back at the beginning of 2014, the price return S&P 500 just slightly outperformed DGRW. Now, bear in mind, there is only 40% overlap, right? So it's absolutely incredible that the performance has been so similar despite only having 40% overlap. Absolutely incredible. Now, when you look at the total return here, it tells a little bit of a different story. DGRW is slightly outperforming the S&P 500. Now, once again, I just can't even believe it. Like, it almost sounds too good to be true that you have such similar performance with the S&P 500, but you only have 40% overlap. It's just mind blowing. I just can't believe it. If you were to say, hey, I'm a dividend investor and I invest in a DGRW, and somebody were to ever say, well, that's stupid. Why don't you just invest in the S&P 500? Well, you can be like, well, actually, and then you can put up your finger. Well, actually, and then you could like kind of do your head shake or whatever. Anyways, you're essentially getting similar returns to the S&P 500, but you're getting a monthly dividend and you're getting more dividend cash flow. All right, now let's take a look at something interesting. Now let's plug this in to a dividend reinvestment calculator. I've shared this calculator a number of times on my channel. So if you've been following the channel for a while, you've seen this before. If you're seeing this for the very first time, you can take a look and you can see I will leave a link to this calculator in the pinned comment below. Okay, so I'm not going to introduce it here. You can follow the instructions here in the bottom. But essentially, if you were to dollar cost average into DGRW, and let's say, for example, you had a starting investment of 100,000. This could be 10,000, it could be 5,000, it could be $1 million. It doesn't matter. You'd have to put it in for you. But if you were starting with $100,000, you were annually investing $2,000, or let's say you were annually investing $1,000 a month, so 12,000, and then you take in the numbers for DGRW. Let's see what the dividend income would look like over a period of time. So after 10 years, you'd have $12,000 in annual dividend income. In 20 years, you'd have over $50,000, and after 30 years, you'd have over $250,000 in dividend income. Absolutely incredible. Like, if you're 20 years old and you're thinking about your future, this should really get you excited. I don't know about you, but this just really gets me excited. And here you can see what the portfolio value would be after the next 30 years. Now, just to humor everybody, let's say, well, Jake, I'm a poor student and I only make $5 an hour because I don't know why. Let's say you have $10,000, right? If you have $10,000, this is what it's going to look like, right? It's going to be different. Let's say you're a hot shot and you make a lot more money, or you house hack and live with your parents and you're able to save money, or whatever, right? The key thing here is make the numbers work. These numbers right here, they don't change. These numbers change, okay? Let's say you had 500,000, right? I don't know, that my small brain can't even comprehend that. Anyways, the cool thing is you can do the math, you can see what levers you have to pull here, and you can forecast what it would reasonably look like in the future. Now let's do one other thing here. Let's take a look at, if you had the money today, what would it look like if you invested into DGRW today? Okay, so if you had $1 million today, $1.5 million today, and you were no longer reinvesting the dividends, you were no longer adding money to the portfolio, what would your dividend income look like? Well, in year one, it'd be over $30,000. In year 10, it'd be over $87,000. Right? And then it keeps going from there. So even though you're not reinvesting the dividends, even though you're not adding more money to the portfolio, the portfolio is still growing organically. Okay. Now, I don't know about you, but $30,000 is not really something that I personally could live off of. And, let's say if we doubled that, 1, 2, 3, even if we doubled it. Now, I know that probably 1 or 5% of the people watching this video are thinking about having $3 million in their portfolio when they retire, but or maybe more. I don't know. Everyone's in a different situation. I don't know if this is the right approach if you were retiring today to throw all your money into DGRW or an ETF similar to DGRW. Okay, that is why your time horizon is so important. That is why I personally have a mixed approach. I have a balanced approach. I have a balanced approach of value and growth. And I am shooting for a much higher dividend yield, right? A much higher dividend yield. And the numbers look entirely different, okay? So that's the math. Once you understand the math, it's then just a matter of making the numbers work to your advantage. So I mentioned at the beginning of the video that I would share some of my thoughts on my plans with this ETF, okay? So I don't think I'm going to invest in a DGRW today. What I plan to do with DGRW is I'm actually considering adding it for our little baby boy Lucas, adding it to his portfolio. That is something that I'm considering. The second thing that we're considering is, if you follow the channel, you know that my wife invests more, is more skewed towards growth. She owns companies like Salesforce, Amazon, really Google, growth-oriented companies. And what we're thinking is, here in the next couple of years, as the market kind of, we'll see how things pan out. But what we're considering doing, and this was our plan all along, was taking the growth from my wife's portfolio and then selling out of that and then repositioning it into an ETF similar to DGRW. So that is something that we're considering. I don't know if I would add it to my portfolio, in my personal portfolio, because like I said, my time horizon is the next 2 years, but I'm trying to find a way where it could make sense to add an ETF like this into my portfolio. It's maybe I would even consider my Roth IRA, because I have a 25-year time horizon in my Roth IRA. It's something that I'm considering. It's something that I want to keep a close eye on, because you look at this is just absolutely incredible. It's absolutely incredible. This is one of those ETFs that I kind of see it as a similar ETF like SCHD and DGRW. It's just a really, really high quality ETF focused on the total return. But like I said, if I was in my 20s, if I had a long-term time horizon, I would definitely have this ETF on my radar. I hope that this was helpful. I hope that this kind of opened your eyes to look beyond just the expense ratio. Now, I don't want to underplay the expense ratio and the importance there. It is very, very important. But considering the performance, considering that it pays a monthly dividend, considering the fund methodology, the index that it tracks, I think it's really, really compelling. It's really interesting. So I'd love to hear what your thoughts are. Is this an ETF that you're considering? Is this an ETF that you have on your radar? I hope the video was helpful. I hope you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.